Good morning, everybody. We're at the end of the week. Who wants to go down the pub? I'm ready to go there right now. Morning, Kay.
Good morning. I'm already there. I'm talking in direct from the pub. Yeah.
Good idea. I should have done that this morning. Packed up my laptop and gone down my local spoons. They usually open at 6 o'clock in the morning. I feel like I need a good drink tonight. I bet you'll be cracking open a few bottles, won't you?
Yeah, it's been some week, right? Everything's on the move. Yeah, we've been talking about stuff like that possibly to happen in our room no later than yesterday. Again, I was repeating this. Really, similarities starting to show with what happened in the 1980s, and perhaps have to be a little careful right here and now. I was talking about a possible dollar melt up before the end of the month, perhaps. Yeah, because month end is right around the corner. That's another one.
Yeah, we've got that as well, haven't we? And quarter
we
end.
can't wait for it, can we? So yeah, I mean, I'm starting to be just a tad careful right here.
Yeah, I'm just this morning. Sometimes it takes a while for it to sink in, but looking at how prices are moving this morning, really for no apparent reason, dollar gaining across the board, bar versus the yen at the moment, significantly, and you just got to start thinking, we're potentially getting to the point where countries and central banks or whatever are going to start saying enough is enough. This is too one way. It's too strong. There's no rhyme or reason behind it. Well, there is a bit of reason behind it. Obviously, we're entering a period of rising interest rates, which is a big driver. But even so, there are limits to what countries will allow their currencies to do. So I think we are getting closer to when at least the rhetoric starts becoming stronger from a lot of countries. The Bank of Japan, or rather the Japanese government, have been banging on about it for ages. The others are starting to see similar now as well, and I think we are edging towards, I wouldn't say we're getting to Plaza Accord type stuff, but to the point where it's going to become a more talked about subject and more worries are going to be concerned, and that's potentially going to affect how things trade going forward. So if for anything, it's going to bring us some decent volatility to trade, I would think. Wouldn't you say, Kay?
Yeah, absolutely. And regarding that, I've always been saying, I mean, the dollar is not done yet, and we are actually in the midst of it right now. We will talk about the yen a bit later, but yeah, overall, I've read some really interesting stuff earlier in the morning, saying that if you compare, and I was the past couple of days I was talking about it in our chat room about the similarities that we are seeing now with the 1980s. 1970s similarities were last week. Now we are already in the 1980s. We're accelerating a little bit in this day and age. But of course, the interest rates are not at the same level, but the amount of money in the system and the affordability of the people is starting to be very comparable to what happened in the Volcker years. So again, me neither. I'm not saying that we're close to a Plaza Accord. We may see, or we may have to wait for another dollar melt up. But look at the yields. Yields are spiking everywhere. But the dollar being the biggest block, the dollar being the one which is the furthest away from the Ukraine crisis, who is actually a beneficiary in a way of this unfortunate development, and people use it now as a safe haven, more and more safe haven currencies. And the higher yields go, the higher the dollar attracts, the more the dollar attracts funds, because you can now get like over 4% to place your money in the States. Even on a short-term basis, 1 year, 2 year. So it's a bit of a self-feeding move, a bit of a vicious or virtuous circle for the dollar right now. But not only in terms of we're getting worried and countries are getting worried, but even I'd say a bit technically, we are getting to levels. I don't like to use the word stretched because the market can go
Keep stretching.
stretch a lot further than we can remain solvent. And I'm not short dollars either, but I'm starting to be a little cautious in selective dollar pairs. Let's put it that way. But we'll talk about the currencies later, and I'll come back to what I just said. But I'm starting to get a little worried. And talking about the month end, it's not actually a coincidence that I'm starting to talk about month end, because if you look at the equity moves lately and the bond moves lately, there is a fair chance that actually month end will see more dollar need because of those equity moves. We'll see what the models are saying, but what I'm looking at from where I stand, we could even see more dollar demand into month end.
Yeah, and if you're a member of our chat room, pop over to the Flowonomics room because we cover a lot of the month-end stuff in there, all the models that come out via the banks showing what they expect in terms of currency moves versus what's happened in stock markets and the like over that month. It can all change around depending on if there's any volatile moves in the latter part of the month. So it's an ever-changing situation. But this end of month is also an end of quarter, end of Q3. So that can be a little bit more spicier. But as I say, we cover that a lot in the chat room, in the Flowonomics room. So if you want to pop over there, we'll keep you informed on that. Okay, well, let's get stuck into it. Bit of random headlines, bits and bobs today. We got obviously a ton of waffle out from Japan yesterday, all the way up to the PM, talking about how they're ready to act and how they needed to act in the yen, obviously. What was also interesting was, and this was something we mentioned yesterday morning, waiting to see whether any of this MOF-BOJ action was coordinated with other countries. We heard from the S&B that they had no involvement. We heard from various others, ECB, that they weren't involved. So it's pretty much left Japan out on its own. Now, the big one was the US and what the US had to say. We were waiting on that quite eagerly yesterday. And the Treasury issued a statement that it looked, rather than an official statement, it was an emailed statement. It looked to be a response to questions rather than then coming out off their own back and issuing a statement. And they pretty much said they understood why Japan was intervening because of the volatility. Long and short, there was no real strong lines for it or against it, which in those terms could be seen as, you know, a bit of a thumbs up, i.e. they're going to let it slide and let them get on with it, rather than showing any negative caution against it, if you like. But the one thing that struck me last night, thinking about it, is that a lot of these central banks were coming out and saying how they didn't join in with this intervention, which tends to make me think two things. A, have there been discussions behind the scenes about maybe a coordinated effort? Because to have people coming out, and a lot of them without being asked and giving that comment, tends to mean they're sort of trying to deflect from that fact that potentially there is something brewing underneath, or there have been conversations. We can probably assume there have been, but officially, you know, trying to deny something that you, in some cases, haven't been asked, can be seen in a weird light, if you like. So, for the moment, Japan's out on their own. How long that lasts, we don't know. Depends on what happens with the moves. Dollar yen has obviously settled down a bit today. Still a fair bit of volatility in the price moves, but as you can see, we're pretty much back where we started in this, you know, 143 zone, pretty much middle of this recent range that we saw between the 140, 150 and the 145. So we're back in the middle here, and taking a bit of a pause, probably, as we might expect. But anyway, we will look at the prices in a bit more detail. But as I say, most of the central banks, or a lot of central banks, came out and said that they weren't part of that intervention. Now, regarding rates, ECB's Kazakhs was out this morning saying that 50 or 75s are on the table for the October ECB meeting. He prefers the 75. He's a bit of a hawk, so not too unexpected there. The Bank of England, they obviously hiked 50 basis points yesterday. It was a 9-0 vote to hike, so not in doubt there. But what was interesting was the vote split. 3 of the MPC members voted for 75 pip hike, 5 went for the 50, and 1 went for a 25. This has got the market juggling rate expectations for the rest of the year. A lot of people expecting maybe 2 75s. Now some are expecting only 1 75. It's all changing around the situation. But what's been out this morning is the UK Chancellor and this so-called mini budget. And it's actually proved fairly important in terms of what's happening in the UK. A lot of tax cuts. Maybe the biggest one to pick out, at least from an investor perspective, is that they are cancelling the corporation tax rise, the business tax rise, which was due to go from 19 to 25%. They're going to keep that at 19% now. They've cancelled that tax rise, which from an investor standpoint is good news. If you're looking around where you want to invest and open up businesses, you look at obviously the tax levels in various countries. So the UK keeping that 19% and not jumping to 25 is a bit of a positive there. Factor in all these new licenses being granted for fracking and energy and that sort of thing gives that sector a bit of a boost. There were other tax cuts to income tax, a reversal of the national insurance increase we got earlier this year. Capital gains taxes were cut as well. Income taxes cut. They scrapped the 45 pence higher tax rate back to the 40. Basic income tax coming down from 20p to 19p. Now, overall, it's not going to be huge for the UK in terms of maybe trading the pound. We saw the pound get above 112 as expected. Took a big slap. Now we're trading down at 111.29. So that's the market's thought on that. This dollar move is continuing and it's overriding everything. But what's going to happen is there's going to be a huge amount of borrowing, extra borrowing to pay for all these tax cuts coming in, and that is probably going to outweigh the positives from these tax cuts because they're going to be borrowing more into a rising interest rate environment. That's not a good sum at all. So that's on that front. We've got to watch out. As I say, the dollar is overriding. Looking at the prices now, as I say, cables, looking like it's going to test 111 in a minute. The euro's not far behind either, down towards the low 97s. So that's still going to keep going. Yellen was also out yesterday. She blamed CPI on the tight labour market, which, as we know, is continuing. There's no real signs of weakening in that jobs market. Initial jobless claims was out yesterday. We'll have a quick run through the data. Sorry, I'm keeping half an eye on the charts as well. Where are we? So initial jobless claims sliding again. Look at the 4-week average, 216 down from 222 last week. No real signs of a turn yet coming in the jobs market, and this is what the Fed are fighting. So looking at today's data quickly, we've had a load of PMIs out at the start of the new month for PMIs. Australia looking a bit better, pip up in manufacturing, bit better, 2 pips in services. We've seen a bit of, again, a switch around or a divergence in the sectors this morning. Look at France, manufacturing dropping further into contraction, but services gaining 3 pips. So, again, we got this sector differences, and we've seen that happening over the early part of the year, I think it was. Germany matching what was expected, but confirming a dip in manufacturing. Services worse as well, all in contraction. So nothing there of good news for Germany. The UK as well, again, all in negative territory, but again, we've seen, services down a little bit, manufacturing up a little bit, again, a bit of divergence there. The fact that it's all negative is the overriding theme there. Today we have the first of the Fed speakers coming out, and the big man's out himself, Powell, at 7 o'clock UK time, so well after markets have closed. Not sure what he's going to say. Likely to reiterate anything that happened at the FOMC, obviously. We've got Brainard and Bowman out as well. Probably the only thing to look for is potential comments on the currency now, given what we're seeing around the world, and maybe some comments on the Bank of Japan. Not really his remit, I don't think, but he could just pay it lip service as well. Kay, you got any other headlines you want to jump around there?
No, I just seen this slap in the sterling. The people are now calculating the costs of the program, and there's going to be anywhere between 150 and 160 billion sterling apparently. And gilt yields are spiking, so the government is going to have to pay up for sponsoring all this spending, and that's what the market is really not liking about the sterling right here and now. It can get to be a positive further down the road if they attract businesses, and yeah, people may be starting to look at buy those accelerations in the cable lower, but I still think it's a gloomy picture as well, with the PMIs not being really well. Sterling is really suffering on the back of these, and that's
just
the, I think,
111, yeah.
And that's the main thing right now is that you've got a strong dollar on the one hand, and you've got weak currencies on the other hand, and that's where you see this acceleration in everything. Right now, I mean, can't get enough dollars. Look at dollar China; it's above 713 now. It's just going, and I think it's dangerous to really stand in the way of these kind of moves. Yesterday, you posted an article about how bonds were getting slapped because people are getting very nervous about everything. And the mechanical effect of that is that again the dollar is underpinned. So for the time being, we got this vicious circle for the rest and the virtuous circle for the dollar, which is going to be broken at some stage. But as I said, we are more and more having the looks of 1980s, and perhaps somewhere the Japanese have understood that is what is that's what's going on. The problem for them is they can hardly stop it because their government is producing stimulus package after stimulus package, and the Bank of Japan is keeping their hands still. The only way, in my opinion, now to stop the yen move is if Kuroda goes like, all right, enough is enough, I'm hiking rates.
Yeah, very much so. Well, Japan's been the poster boy, really, haven't they? You know, this all started back when we were, down at the low 100s, the 110 sort of thing. 2 years ago, over 2 years ago now. I laugh sometimes because I rode, as you know, I had those dollar yen longs all through the inflation startup. I thought I did well getting out around 125. So it's got another 2,000 pips. It's bonkers, absolute bonkers. But that was the start of it, and now we're seeing the rest of it. I mean, this is looking very routish now. It's getting more and more routish looking, particularly for the pound. So yeah, I think we're going to get close to the point where comments are going to be seen much stronger. But just looking at the vols today, not as high as I would expect. I'll just show you this. This is something you can look at. I make no idea about the firm Century Derivatives, but they have this handy widget. It's the 1 month vols that I tend to look at for the three majors here. Gives you a sense of how volatile things are. I'm surprised these are not higher. I would have thought dollar yen might be somewhere up around the 15-16s after yesterday, but we have seemed to calm down today. These are up as well. Anything over 7 or 8%, you're getting into real volatile territory. Under 6-7%, things are really quiet. So to have these up this high, shows what the environment, and they've been up this high for a long amount of time. So naturally, we're seeing that reflected in the price moves. Here we have Cable, where's he got down to? 77's odds, back up above 111. You know, this is choppy city, and you've got to be very careful if you're trading this. You know, trying to catch that knife. You know, the harder we fall, sometimes the more volatile we can bounce. So, you know, one bit of news and we could be back above 112 in a flash. So very dangerous. You need to be careful when trading this. As far as me trading it, I didn't do an awful lot yesterday in the end. More managing positions. I've got a short on my Putin short in euro dollar, which is continuing to run nicely lower. Kay mentioned this, the dollar yuan, and I am looking up at this zone for a potential trade, just purely to play the technical side of it. Big, massive double top. You could call it a double top. We've got this inside resistance here after we've had these highs. So that's one area I'm looking at there. But otherwise, I'm going to be taking this very carefully. There's a lot of mess to be had here. If we look at go back to cable, you've really got to take a longer view. You know, see where the levels are. We're getting into, as Kay mentioned, you know, areas we've not seen for, you know, decades. So you've got to be careful about where you lay your techs at. You know, pretty much we're looking back to this 1985 period, and that's down at 105. So on the long view, just got to be very careful. I know a couple of guys have got a trend line coming in on these lows here. That's probably one area to look at as well. But we are looking at multi-year levels if you're trying to find your support resistance areas. So what do you do here, Kay? You taking it a bit more cautious, and how do you look at these long-term levels?
Yeah, well, yesterday I had a long day over the Bank of Japan, but I've been trading quite a bit of it, as the guys in the room know. But still, I'm not against. I'm not trading. That's the thing. I was buying dips, and I was buying the intervention dips, and then taking it off on rallies. The thing is, we can trade it in various ways, right? You can trade against the interventions, but that's not what I did. I was just trading fundamentals and interventions, giving me levels where I think fundamentals were still justified to trade the other side. You just take the interest rate differentials. You just take what the Bank of Japan was telling us. You just take the negative trade balance in Japan. You just take the negative current account in Japan, and there's, to me, no fundamental reason for dollar yen to come off if you take everything into the picture. So I was rather trading it with stabs on the long side of the dollar yen. Today I had a couple of stabs at as I was saying in the room, a couple of stabs, quick things, and I can't still really sell dollars. But this being said, looking at the speed, looking at how everything seems to be a bit, it's all in the accelerator right now, right? And those moves are most of the time worrying me a little bit. So I'm going to err on the cautious side, and the cautious side being that I think there may be a little issue coming with risk. So as well, listeners here know as well that I'm short Euro Max, and I actually took it off today. Took it off this morning, just at the start of the show, really. And I've also lobbed out the rest of my dollar China for now, because but that's for a different reason. We are 2% away in dollar CNH from where the PBOC fixing was overnight, and that historically, which is a big word in this day and age, but historically is a bit of a stretch point, we could say. So rather than looking at the text and everything, this is, and since I'm starting to be a little worried about those moves, I've taken it off today as well. But for the rest, I'm still not ready. I don't think we can talk about a dollar turn yet, especially with what we've seen yesterday. Also bearing in mind with what's coming next week, possibly. But yeah, I think caution is now the word. So I'm going to be trading much more short term than, and then look at where we are at the end of the month to see if the long-term positions need to be put on a more medium-term position. I don't like to talk about long-term positions in this day and age, but to see if those positions are still valid.
Yeah. And Ironut's just asked a question. Kiwi should be safer than the pound on this move, right? Well, let's look at the Kiwi. Here we go. There.
But there's a lot more going on in the pound right now. So
yeah,
the thing is, you're since the pound is getting slaughtered, yeah, the Kiwi will remain better relative to the pound, and I think that unit is probably in sterling Kiwi. Yeah, could be a nice trade, but then I'm gonna let Ryan look at it. But it's just because one of the two currencies is much more in the picture than the other one right now.
Yeah, exactly. In terms of versus the dollar, it's the same as this picture here is the same everywhere, really. Same in cable, same in Aussie dollar. I don't look at pound Kiwi a lot, but let's have a quick look. So yeah, you could say it's looking a bit better. Well, the pound's looking a bit better, I would say, versus the Kiwi in this instance. But what's you're in? Oh, okay, you're in Kiwi dollar. So yeah, it's looking exactly the same as everything else. This is all a dollar move. Yeah, you're going to get your moves in between the currencies. Euro sterling is up because the weight of the pound in this move is worse than the euro dollar. So you're going to get those differences between the crosses. So yeah, you can use the fundamentals of the crosses. Kiwi pound takes the dollar out of the situation. Then you're just playing what's better for the pound or the Kiwi. But as you're in Kiwi dollar, it's going the same way as everything else versus dollar at the moment. Michael, we'll look at dollar CAD in a moment. What I wanted to add to the dollar yen story. Saw a lot of people yesterday coming out and saying intervention is doomed to fail. Intervention never works, never does what it's supposed to. It's the question isn't as simple as that. It's about the objectives of intervention. The bank, or let's say the Ministry of Finance, aren't intervening to get dollar yen down 1,000 pips. That is not their objective. Their objective is to take the speculative and volatility out of the moves they've been seeing. Now, per se, they may not have, exact price levels. Behind the scenes, they may say, okay, this is too far, that's too far. But publicly, they're unlikely to start putting numbers on where it's too strong, too weak, that sort of thing. So it's all about the objective. The objective is to take out the volatility and the speculation. So from here, dollar yen can go to 150, 160, 180, let's say, as long as it doesn't do that really fast. If we're seeing 200-300 pip moves up a day, they're going to come in and intervene. If it takes 6 months to get there, they're not going to intervene unless they decide to change their playbook. So it's not about intervention isn't working because we're not 1,000 pips lower, 500 pips lower, whatever. It's what their objective is. And that's what a lot of people miss. And that's what's going to catch a lot of people out, because they think, okay, we're all going to pile in at 145 because that's where we think the Bank of Japan are going to be sitting on the offer. And then they might find it goes through and we're trading 147 in a week's time. So you have to be very careful with this. You have to understand the nature of the intervention, why they're intervening. It's different to the SMB, how they played it, vastly different objectives. Dollar CAD, let's have a quick look at that then. Massively off to the races as far as everything else goes. Obviously, yeah, we've got the old consideration to take into account here. More so, this is, again, just a pure dollar move. But USO is adding to it as well. We're heading up towards this big fig. Let me get it on a wider chart. That might help. So here we are heading up to that big 61.8 fib. Bit of a line in the sand there. If we had break that, we're probably heading up towards 140. So big numbers there. It's looking a big breakout. You've got your support points. On the way back down, we found a bit of support just ahead of the 50 fib. We found support into this broken trend line, top of the channel there. So if we get pullbacks, those are the areas you want to look at. But looking at oil, you know, every chance we're looking to break this 80 level. If it goes, you're going to see dollar CAD rising even higher, and that'll be the catalyst. So two forces at play here for the CAD, the US dollar side and the oil side. Kay, do you want to have a little look at your round robin on a few pairs?
Yes, sure, mate. I'm just looking at the question. Steven says, can you elaborate on the rate differential concept? Well, the concept is easy. I mean, like any market, it's a case of demand and supply, and what central banks are doing, and then what the market is doing in reaction to it. So and money moves at different speeds in different countries. So it's pretty simple. It's the dollar market being the biggest market of them all, the US bond market being the deepest interest rate market in the world, the dollar still being the reserve currency, so that attracts a lot of cash. So when the interest rates are in favor or against your own currency versus the dollar, that creates an interest rate differential, as we say, and then some people are trying to take advantage of it, or it does just have a mechanical effect on the currencies. Like, for instance, if you take Japan and the US, the Japanese investors, their biggest investments, the biggest direction of their foreign investments is in the US. So they will be buyer of dollars to then buy US assets to try and capture more than their own zero interest rates. So that's one of the effects of interest rate differentials. And if you have central banks who diverge on top of that, like the Fed is hiking like mad right now, 75 BPs a shot, and you've got Sake-san Kuroda keeping his hand still, with his yields kept around zero, and then you create huge differentials, which create huge money flows, and that's what we are seeing, which is weighing on the yen, especially since we take last year when the Fed started to pivot around May, June. Look at where the dollar yen was then, and look at where we are now, and the effect of interest rate differentials is just pretty clear. And there's a few other factors to add to that, but purely only for interest rate differentials, that is it. Look at a bit of a more exotic cross like Euro-MX, that I've been trading for a little while. Actually for a long while now. The ECB has been keeping rates negative for a long time, just now starting to creep out of negative territory. In the meantime, Banxico has been ramping up rates to 8%, or I don't know how much. Yeah, 8.5%. So there's such a big interest rate differential that carry trades are very attractive, especially Mexico, because you have to choose your carry trades right, of course. So I'm just going to not give a secret, but an observation is that Mexico is part of the manufacturing hub for Americas, for the States. They have a very close relationship to the States. So even though dollar mix could go a little bit up, which it actually did not that much, but and when it ramps up its interest rates, and is as well far from where all the negative war and geopolitical action is playing, all of a sudden this currency becomes really very attractive to own, seeing the high interest rate differentials versus currencies like euro, yen, Swiss to a certain extent, but I rarely trade Swiss nowadays if it's not being long Swiss because of I fear a little bit about risk and how the SMB is playing it. So, but again, things against the euro and the yen, for instance, have been prime examples of how to play interest rate differentials. Here we go. My screens.
Just on that, if I may, Kay, if you want to take it down to real simple terms, okay. If I gave you 10 grand and said you need to put this in a bank account, are you going to put in a bank account that pays 3.25% interest like the US, or are you going to put it in a Eurozone country that pays 1.25% interest? That's how you start to look at interest rate differentials, because that's how money flows. It looks for yield. Where can it get the best interest on its money, the best yield on its money? And then from there, you break it down and you can dig deeper as you like. But if you want to know, why flows move around the major economies on the interest rate differentials, that's purely it. Why would I put my money where I get 1%, where I can put it somewhere I can get 3%? It's as simple as that. And then obviously, as Kay's explained, then you get into the nitty gritty of it, and you look at the economies, what they're doing, so on and so forth. Anyway, sorry, mate, I'll let you crack on. Let me stop my screen sharing. 1 second. There you go, mate.
Right. Where is the chat room here? Okay. First, have a quick look at gold. It's not going too many places. We're still below that 1680-85 zone, which really needs to break higher. It's unfortunately, in my opinion, not going to happen for as long as we're in this particular situation in the on the dollar side. I think. Well, I don't think a lot, but in gold right now. But it needs to break, in my opinion, through 1652, call it 1650, this trend line to accelerate again. And then there's people looking at what is it, 1615. I have no position. I don't really want to have a position in there, but I'm looking at it. It's like as I've been saying a couple of times, trading is like going to the restaurant. You can look at the whole menu, but that's not while you have to eat everything. And as tell yourself, unless you're called Steve, then you really eat everything. But yeah, this 1650 here is a bit of a zone for me, and top side 80.85. If it would ever break down due to the sheer strength of the dollar. And the high interest rates as well. Don't forget that those instruments don't pay interest. On the contrary, some may charge you to just have them in position. It could break down and go down to 16, 13, 15 perhaps. But if I only would go onto geopolitics, I don't feel like being too short this one either. But note, it's still quite in a negative bias, and a breaks up 1650 could see a bit of an acceleration. The silver is a completely different picture in my opinion, even though it falters also just above 1980s, where this trend line comes in. Haven't had a daily close above. And now we are looking back at this 1920-25. I wouldn't exclude a move back down to 1870s, but thanks to its more industrial need for silver, I think this may be doing a bit better still than gold. And then this look at the oils, it's a bit of a we're in a bit of a danger zone. I mean, there's no other way to say it, right? We've broken. We're trying to trade around this 85, and now it's starting to be a resistance right up there, 85, 86. We're back on the prior lows around 81.5 as we speak. I think there's a possibility that this could go and have a look below 80, especially looking at the way the dollar is behaving. It seems now the dollar is really dragging everything in its wake. So for the time being, unless the dollar starts to flip around, and this can then start to go higher again. To be clear, I'm not bearish oil. I think sometime in the future, and it may be perhaps not before we reach here or even 70, 76, 77, but in time, I reckon there's a case for gold to bottom out for oil to bottom out somewhere and start to go higher again. So that's, Brent is in the same situation, but it's still holding the fort a little bit better. That's likely because of Norway's direct production output to Europe, and with the worries that we have again surrounding Russia and Ukraine, Brent seems to hold. It's in the same kind of picture as WTI, but it seems to hold a little bit better. So as long as we're above this 86.5, we're $2 above. I wouldn't start to panic on what happened what happens in Brent. All right, then look at a few of those dollar pairs. So in the really short term, this is the intervention in dollar yen, and we are back. We went back sort of to the midpoint of the high to yesterday's lows, around this 143.25. There's also this 143.15, which is a bit of a crossroad, a bit of a traffic zone that we have seen on the way up and down. And then we just had this pretty large spike on the way down. It lost like 80 pips in 30 seconds time. So market is perhaps thinking about interventions. The way it stabilizes right here and now is making me more think that some heavy hand took profit in some dollars, or missed the train on the first legs down, and then decided to lob some out above 143. That's more the looks that it has to me. So basically, it's a tough one to call, and it's a tough one to fight. And the MOF is really they're strong. People are always saying like, yeah, but they can only intervene to the limit of their to the extent of their reserves, and they won't let all their reserves go just because of an intervention. They will not do that. But it's also equally difficult to fight them, because they have the small amount of 1.2 or 1.3 trillion dollars in reserves, and they have about 110 billion just parked at the Fed, ready to use straight away. So from that point of view, if you try to buy it, don't buy it because you want to fight the MOF. That would be the wrong reason. If you want to buy dollar yen, or if you want to sell it, let's take the two ends of it. If you want to buy dollar yen, it's as I said before, fundamentals. I can't see a decent fundamental to buy yen right now in the context that we are seeing. We're seeing those 375 in the US 10s. You only have to look at the rest of them. Germany to near 2%. You see the shorter end in the dollar here. They're also ramping higher. But then you look at the longer end on Germany as well. We're at 2%. We're on the 30 years. We're near 2%. Look at UK yields. They're absolutely ramping higher. You look at the New Zealand, Aussie, and Canada are slower. But look at all the yields, and then look at where Sake-san, Mr. Kuroda, is keeping his yields, 0.25% max. So I mean, only for the reasons of the Bank of Japan, I don't see too many reasons to buy yen. And then the ones that I've said earlier is that the government is still putting a lot of stimulus into the system, and they have a negative trade balance right now in Japan as well. That flips over from month to month, but for the time being it's negative, and more specifically, they have a negative current account balance, which is not really great for a currency either. So that for the dollar yen. If you look at levels, I'm keeping a close eye on this 142.25. The 141.60 was another one on the shorter time frame. 140, the figure is going to be a big one. Yesterday's low around 140.50 as well. I think Ryan showed this 140.60 yesterday. That whole zone 130, 140, 140.5. If they ever intervene again, is already going to be a big zone. And then, if you're a real longer termer, and I do think some people are really longer term long dollar yen. I think the real long termers, they are not really going to panic, and unless we start to break below 138 or even 136, they are likely long this whole thing from if not Ryan's absolutely great pick around here, they must be long from roughly where I started to be long around the 110 zone, and having bought more and more and more on the way up. That's for the long terms. In the short term, we have to, of course, well, now look at the 143.15, and then above there likely 144.40 and 145 again. But again, I'm personally I'm not buying in right now. There's the crosses, yeah, the yen crosses have, of course, collapsed on the back of the interventions and on the back of weakness of the currencies versus the dollar on the other hand. Somebody was talking about the Kiwi. I'm not a big fan of Kiwi right here and now, because the RBNZ has put us a little bit less bullish for Kiwi, in my opinion, saying that they may start to pause around the end of the year. So since we had this break here in the Kiwi yen, we haven't really been above anymore, around 83.90. I think there's an interesting zone where we are really right now, 82.5 on the Kiwi yen. I'd keep an eye on that. It's also not too far from this level. If we start to hold, and I'm going to go out on a limb here, if we start to hold here, we could have a retest of 84, and then also look at where the 200 DMA is. For good order's sake, I'm not a big fan of moving averages in FX pairs, but some people are looking at it. So the 200 DMA is around here as well. There's one, in my opinion, and that's going to be on the back of oil, is Canada yen. That's not the Canada yen, that's the Euro Canada. Here, Canada yen. Look at this trend line. As I was saying, we've gone very close to this bullish flag, but this trend line here, we're trading around. It's around 105.60. I'm going to pay attention to that for a weekly close and starting to go into the next week, because we've stopped right here even on the interventions. We stopped right here around 104s, mid 104s. If this starts to creep higher again, but we are going to need a bit of help from the oil side as well. This could be an interesting one, perhaps in 2 months, and I'm going to keep a close eye on that one. And then quick look at what's happening in China. This is really explosive, right? If you look at it's a daily, it's really very, very explosive. And I think it's starting to get just a little, I will not use the word overdone, but it's starting to get a little rich compared to what the PBOC fixings are doing. So I wouldn't mind now to start to see a bit of a correction. And then if for people following the MEX we've been talking about, if you can see the MEX has been behaving relatively well, right? We are going up and down. It's an EM currency after all, but we are staying within this tighter formation for what the dollar MEX is concerned, and it's going to take a move back above 2025 for the dollar mix to catch up on the rest, perhaps, and I'm not even sure it's going to happen. And this has been holding, and I've been talking about this level, 1975.80. This is one to keep a close eye on if ever dollar mix starts to come off again, which could lead us then back to the red trend line. Last one, euro mix. I'm starting to be a little worried about risk. So people in the room will know what I've done today, and we are going to monitor this. Just keep this 1960s in mind for close of the week. And with that, Ryan, I'm going to give it back to you. Michael, I just did cover the dollar mix. Have you seen it? All right. Yeah. Okay. So back to you.
Good stuff. Thank you very much. Yeah, just a comment from Gavin. I don't know if you saw my reply asking about the traders funding program and how long it takes to join. I'm not 100% sure. I can find that out for you. If you're the Gavin who follows us on Twitter, the man from Dundee, just let me know and I can DM you there or get in touch with you some other way. And for those who may not know about it, this is the traders funding program that ForexAnalytix is running, where you can come and trade account up to $1 million just for the cost of the assessment fee. Ranges from £250, $250 for the basic one there. If you want to have a look, I've put the link in there. You can check that out, some of the details. Let me get down to the page. There we go. So you can see some of the accounts there. You do also get free access to the ForexAnalytix platform, depending on which sort of account you pick up. So if you want to come have a look at that, your risk is only the fee you pay. So if you get into an account, pass the assessment, get a live account, and you get hit black swan event like Bank of Japan intervention, and if you're not well enough protected and your account gets wiped out, you're not going to be liable for that loss. All you're liable for is the evaluation fee that you paid up front. You get 75% of the profits, 25% goes to ForexAnalytix. But yeah, it's just a way of lifting your account up, you know, upgrading your account, your trade size, without as much of the risk of putting that amount of money into an account. So if you want to check that out, as I said, we've had a fair few people from the Flow Show joining that up. Lots of people passing the evaluation and getting live accounts. I'm not going to beat around the bush. It forces you, the conditions forces you to be very disciplined to get through the assessment and to continue the account. But that's there for a reason. The discipline is what you need from the start. You need to be very, very tight on your discipline in your trading, whatever level of trader you are. But if you get that right at the start, then you can build on that and then you can develop further. But getting that discipline is very important. But anyway, I've put that up for you there. Just going back to what Kay was saying about the RBNZ. Yeah, they in their last, one of the last announcements said that they're likely to only have 2 more hikes in the pipe before they pause. They could be a good poster child for what is going to happen with central banks. They might become one of the first, let's call them the major central banks, to start pausing this hike path. Is it going to work? Is inflation going to pull back over there? Are they going to see the effects of it? Or will they need to then reverse and start hiking more? So if you want an idea, rough idea of what might happen with other central banks, look at these sort of central banks that are acting ahead of the rest of them. You know, if they start pausing, if they start cutting because the economy is heading into a deep recession, it might give us some idea of what's going to happen to the others in terms of the mechanics of it all. So keep an eye on that over the months ahead. Right, on that note, I think we'll call that a day. Just looking at the calendar quickly, what's coming up: Canada retail sales and the S&P Global Manufacturing for the US. Keep an eye on those numbers as well, and POW later on this evening after the UK close. Otherwise, I hope you've all had a good week. I hope you haven't been caught out by the intervention stuff. I hope we've given you a bit of insight into that, how it works, what to look for, what it means. And I hope what we do on this show guides you through your trading. You can always come and join us on the ForexAnalytix platform to speak to us every day, all through the day. Thank you as always to Stel, who's not here, and the K-Meister for all their valuable input this week. I hope you have a wonderful weekend. Peace and love to you all. See you on Monday.
Have a great weekend, all.